السلام عليكم. بإذن الله I will complete speaking about my course Advanced Cost Accounting for 4th year Accounting Department and Customs and Financial Studies Department. Today I will speak about comprehensive example as a revision of everything about standard costing, the first part in my course. In this example, بإذن الله, I will repeat again how to analyze everything about direct material, direct labor, and manufacturing overhead. In our example, we have standard data and actual data for a department using standard costs and its activity level measured by direct labor hours. The standard or budget data, here we have planned production 18,000 units, and we have standard direct labor hours 36,000 hours. It equals 90% of normal capacity of the company or of the department, I mean. For direct material, we have two kinds of direct material, X1 and X2, and we have information about standard quantity per unit and standard price per kilogram for each one. And direct labor cost according to the budget, $90,000, and budgeted variable overhead 108, and budgeted fixed overhead 144. This is my standard, or what should be according to my budget. Okay, after finishing standard, we will speak about the actual costs. Actually, it's another story. My actual production 16,000 units. About direct material, I have two kinds of direct materials. The first one, X1, actual cost of X1 200,000, and the price variance of X1 is 1 per kilogram unfavorable. You hear unfavorable. Okay. X2, the amount purchased cost is 160,000, and there is no beginning balance of inventory, and the ending balance of inventory was 10,000. For X2, there is no price variance. And the actual cost of direct labor 84, actual direct labor hours 40,000 hours, actual cost of variable overhead 124, and actual cost of fixed overhead 140,000. I have budget for standard costs. I have actual for direct material, for direct labor, for overhead. The requirement is to calculate the variances. Here my requirement is to apply four-way analysis of direct material, I mean 4 variances for direct material, 3-way analysis of direct labor, 3 variances of direct labor, and for variable overhead and fixed overhead we apply only 2-way, and our requirement here is to prepare performance report for both variable overhead and fixed overhead. So I repeat again, speaking about how to analyze direct material using 4-way, how to analyze direct labor using 3-way, and how to analyze variable and fixed overhead using performance report. Okay, I will begin with the first requirement. I mean direct material. Again, direct material. Don't forget, when I speak about direct material, I need to calculate the variance of direct material. Any variance, don't forget, actual minus standard. So you have firstly to calculate actual direct material cost and standard direct material cost. Okay, this my information, this part of information about the actual of direct material and standard of direct material from our comprehensive example. Okay, I told you before in our lectures that your problem is how to calculate firstly the actual and the standard. If you calculate the actual and the standard for direct material or for direct labor or for overhead, everything will be very simple. The equations are the same. The performance report will be the same. So there is no problem. Okay? For direct material, my table here, I speak about the actual for direct material, actual quantity, actual price, and actual cost. As actual cost, you know, actual cost is the total of actual quantity times actual price. Here I have two kinds of material, X1 and X2. I will calculate the actual and the standard for both of them. Okay, using my information at the top of this slide here, I have in my left hand I have actual and in my right hand I have standard. Okay, for actual here, for X1 I have actual cost 200. So very simple, actual cost is 200,000. Okay, given, it's given 200,000. So my problem, I need to complete actual price and actual quantity used. Again, actual price and actual quantity used. If I have, or if I can get actual quantity used, I can get actual price. Or if I can get actual price, I can get actual quantity used. So you have to read carefully the information in your example. Okay, for X1 I have only two amounts. The first one, actual cost, here I have actual cost. The second is what? Price variance of this kind of material, I mean X1, is what? Yes, it's 1 per kilogram unfavorable. He gives me what? Price variance. So I can using price variance to calculate actual price. How to calculate price variance? Do you remember how to calculate price variance? Yes, any variance actual minus standard, don't forget. So when I speak about price variance will equal actual price minus standard price. Here the difference for 1 kilogram and for 1 kilogram, okay, actual price minus standard price unfavorable. When we say unfavorable, it means it's positive. So it's very simple. Price variance, according to my information here, given actual price minus standard price will equal positive 1. Why positive 1? U here means unfavorable. Okay, I don't have actual price. I speak about I search about how much is my actual price, but I have standard. How much is the standard price for X1? Okay, you have at the top, don't forget, you have at the top of your slide here the standard price for X1. The standard price for X1 here is 3. So actual price minus 3 equal positive 1. So I can calculate actual price. Actual price will equal 4. Yes, will equal 4. So for X1, I have, yes, actual cost given, and from the information of price variance I can get the actual price. My actual price according to this information is 4. Yes, 4. Again, actual cost 200,000, actual price 4. So I can get, very simple, I can get what? Actual use. How to calculate actual quantity used? Actual cost, yes, divided by 4 will equal 50,000. Again, will equal 50,000. You have to know, for actual, you need to know 3 kinds of amounts: actual quantity used, actual price, and actual cost. In this problem, we have actual cost, and we have information to get and calculate actual price, so it's very simple. I can get actual quantity used. This for X1. I will repeat again for X2. What about the X2? I need also actual cost, actual price, actual quantity used. You have to calculate at least 2 of them, and the third will be complementary. Okay, here for X2 my information is the amount purchased cost. The amount what? Purchased cost is 160,000. I don't need purchased cost. I need, yes, actual quantity used cost. The cost of quantity used, not the cost of quantity purchased. Okay, here I have information. There is no beginning balance of inventory, and the ending was 10,000. Okay, here you have to go back to the third year, and maybe in the first year in accounting principles, if you remember, on third year in cost accounting principles. In accounting principles, how can we calculate cost of goods sold? Do you remember? Beginning balance in merchandising company. Beginning balance plus net purchase minus ending will equal cost of goods sold. In manufacturing company, do you remember the first problem when you calculate cost of finished goods? How to calculate cost of what? Cost of raw material used. Do you remember the equation? The equation like cost of goods sold, but not for goods, but for raw material. So I can calculate cost of raw material used using the same equation, if you remember. Here, don't use this amount. I mean 160,000, because the amount of purchase, but I need the amount of used, only used. Okay? How to calculate the cost of raw material used? Very simple equation. Beginning balance of inventory plus purchased minus ending. Here I don't have beginning balance of inventory, and the cost of purchase 160,000 minus ending 10. So the actual cost of raw material used will equal 150. Again 150. Again, don't use when the actual, it's very real situation. when the actual cost for raw material used equals purchased cost if there is no beginning and ending inventory, or there is no change in beginning and ending inventory. It's very rare situation. Okay, you have to know that there is a difference between what I purchase and what I use. Here I calculate actual cost. I need one of two. If I can calculate actual price, I can get actual quantity like X1. Okay, here without price variance, again without price variance for X2, very simple. What we mean without price variance? Without price variance means the actual price, yes, equals standard price. For X2 there is no difference between actual and standard. I don't know actual, but I have standard. Standard, don't forget, you have to go at the top in your right hand. For X2 you will find that the standard price here for X2 is $2. Okay, so I can say again, after calculating actual cost for X2 and actual price, we can calculate actual quantity used. Actual quantity used will equal 150,000 divided by actual price here 2. So the actual quantity used, yes, 75,000. 75. What about standard? From my point of view, according to my complications in actual cost, it will be very simple. The first column for standard here, standard quantity allowed. Don't forget, allowed for actual production. We have, yes, we have equation to calculate. This is my equation to calculate standard quantity allowed. Actual production units times standard quantity per unit. Actual quantity, we have actual quantity or actual production, I mean. Here I have 16,000 units, and the standard quantity for X1 at the top of the slide here, at the top, standard quantity per unit, and your right side here, X1 4 kilograms and X2 also 4 kilograms. So the standard quantity for X1 will equal, yes, will equal 64, will equal 64. And also because the same standard quantity for each X1 and X2, I mean both of them, will equal also 64. This is after calculating. Standard price, very simple, given here. Standard price for X1, yes, standard price 3, and the standard price for X2 will equal 2 here, given, both of them given here. If I have standard quantity allowed and standard price, I can calculate the standard cost for each kind of direct material. For X1 I mean 192, and for X2 will equal 128. This is my all what I need to prepare performance report or to calculate the variances using the equations. Okay, I need the actual for X1, X2, and I need the standard. Okay, now I am ready to analyze and calculate the variances according to my requirement here, 4-way analysis. Okay, again I will begin using this table. Okay, I use this table for all my steps. I mean, I speak about direct material only, okay? The first step is to calculate the total variance. Again, calculate the total variance of direct material. Here I have two kinds of material, no problem, okay? How to calculate the total variance? The total variance is the difference between actual cost minus standard cost. Again, actual cost minus standard cost. From the table. Again, from the table. From the table here I have actual cost for x1 200,000 and for x2 150. And the standard, the last column of the table here, standard cost. For x1 192, for x2 128. Here the actual cost for both x1 and x2 more than the standard, so both of them here, the difference between the actual and standard for x1 positive 8,000, positive means unfavorable. For x2 positive also 22, unfavorable, so the total of them is positive 30, unfavorable. This my total variance. Again, this my total variance of direct material. I ask myself, we will use our table to calculate our variances. The first one, don't forget mixed variance. Mixed variance equals actual quantity minus actual quantity at standard mix times standard price. Here I have actual quantity and standard price from the table. So my problem is to calculate actual quantity and standard mix. To calculate the actual quantity and standard mix, we need actual quantity and standard quantity, both of them from our table, and we need to recalculate actual quantity and standard mix. The way to calculate looks like preparing performance report. I mean, I need actual quantity from the table, number one. Number three, standard quantity from the table also. And my problem is how to calculate actual quantity and standard mix. Already we have actual quantity, but your problem is how to calculate standard mix. Okay? Yes, I need actual quantity from the table. Here my actual quantity. For x1 50,000, for x2 75, so the total of them 125. And also I need standard quantity from the table for x1 64 and for x2 64, so the total of them 128. My problem not in actual or standard quantity, because both of them from my table, but I have to calculate actual quantity using standard max percentage. So I need actual quantity from my left hand, from number one I mean. The total of actual quantity here 125. Okay, I need what? Actual quantity. I need the total of actual quantity. This is the total of actual quantity. Okay, and I need to recalculate the amount of x1 and x2 using the standard max percentage. So I will depend on standard quantity here to calculate the percentage. Again, to calculate the percentage. Okay, how to calculate the percentage? Again, how to calculate the percentage? Very simple. If you remember joint cost, here I have x1 standard quantity 64 and the total of standard quantities for all raw material kinds 128. So I can calculate the percentage of x1 and so on. Okay? Yes, x1 will equal 64 over 128 will equal 50%. Will equal 50%. Also, now after calculating the percentage of standard mix, don't forget the percentage for x1 and x2 because the standard quantity is the same for both of them. Do you remember? Yes, it's 50% for x1 and 50% for x2. Here I have actual quantity. The total of actual quantity is 125, and I have the standard mix percentage. So there is no problem. It's easy to allocate the total actual quantity or distribute the total actual quantity between x1 and x2. Again, how much is the actual quantity at standard mix for x1? Yes, 125 times 50%. Again, 125 is the total of actual quantity times the percentage of x1 here is 50%. 125 times 50% will equal, yes, 62,500. Again, 62,500. What about x2? Here also, to calculate x2, I will use the same amounts because the total of actual quantity, I will not change it. It will equal 125 times the percentage of x2 here also equal, yes, 50%. So the actual quantity at standard max for x2 here also will equal 62,500. After calculating or having actual quantity for x1 and x2, actual quantity at standard max for both of them, and also standard quantity, I am ready to calculate the mix variance and the yield variance. Again, I will use this information to calculate. We will use the difference between 1 and 2, I mean actual quantity and actual quantity at standard mix, to calculate mix variance. And the difference between 2 and 3, I mean actual quantity at standard mix and standard quantity, the difference between the two amounts, I mean, in calculating yield variance. Okay, now I am ready to calculate mix variance and yield variance. Don't forget, the mix variance equals actual quantity minus actual quantity at standard max times standard price. From my main table I will get standard price, but from the last calculations we have 1 minus 2. Don't forget 1 minus 2, I mean actual quantity minus actual quantity and standard max for x1 and for x2. If I calculate the mix variance for x1 and x2, this my amounts. x1, the actual quantity for x1, 50 minus actual quantity and standard max for x1 also, 62,500 times standard price 3. Here 50 minus 62,500, negative 12,500. Negative 12,500 times 3 will be negative 37,500. Negative, yes, it's favorable variance. But for x2, I speak about 75 minus 62,500 times 2, he's positive. I mean positive. The variance is positive and favorable. One of them is negative 37,500, positive 25. So the total will be negative because negative more than positive here, negative 12,500 F. It is the max variance. Okay. Yield variance. Yield variance is actual quantity at standard max minus standard quantity. Again, the second part when I calculate actual quantity at standard max. Okay. 2 minus 3 I mean. Times the standard price, the same standard. It's pure price variance. Pure price variance. Price variance will equal what? Actual price minus standard price times standard quantity. Again, times standard quantity. Here my table. Again, here my table. I need what? I need actual price. Here I have actual price 4 and 2 for x1 and x2. And I need what? Standard price. Here I have also in standard side of my table. Here I have standard price 3 and 2 for x1 and x2, and times what? Standard quantity. Everything is given here. So I mean everything is calculated. Pure price variance for x1, 4 minus 3, I mean positive 1 times 64 will equal 64 unfavorable. For x2, if you remember, there is no variance. Again, there is no variance in my comprehensive example. If you remember, there is no variance for price. So 0 times 64 will equal 0. So the total 1,000 unfavorable. The last variance, if I speak about four-way for direct material, is joint variance. Again, joint variance is, yes, difference between quantities times difference between prices, or delta quantity times delta price. For x1, the difference between quantities will equal negative 14. The difference between price will equal positive 1. So here negative 14 favorable. For x2, the difference between quantities positive 11, but I don't have difference between prices, so there is no joint variance for x2. I told you before, if you remember, if actual price equals standard price, there is no price variance and joint variance. Okay, for x2, I mean here for x2. Okay, so the total of joint variance here is 14 favorable. Again, to calculate and analyze direct material using four-way, firstly, you have to prepare your table. Secondly, you have to calculate the total variance of direct material. Thirdly, you have to analyze mix, yield, price, and joint variance. After finishing calculating the four variances, you have to check your answer. Again, don't forget, you have to check your answer. You answer about why I have the total variance of direct material. What are the reasons of raw material total variance? Don't forget, the total of direct material variance must equal 4 reasons according to four-way analysis here. Okay, so if you remember, the total variance here in my example, 30,000 unfavorable. So the total of mix, yield, price, and joint, this is my amounts of each kind of variance. The total of them must equal 30,000 unfavorable. Okay, the maximum analysis for direct material is 4. Again, is 4-way. My second requirement here in my problem is to analyze direct labor. Again, direct labor using 3-way. Very simple. Again, using 3-way. Don't forget, the first step is prepare the table of direct labor costs actual and standard. The second step, calculating the total variance of direct labor and then analyze. Okay, this is my information from my comprehensive example related to direct labor. Don't forget my actual production 16,000, my actual cost of direct labor 84, my actual direct labor hours 40. Here I have actual hours and actual cost. About standard, I have budget. If you remember, I have budget. Planned production 18 and standard direct labor hours for the budget 36, and direct labor at the budget, again at the budget here 90. Okay, all of them according to the budget, but I don't calculate for the budget, I calculate for the actual production, don't forget. Okay, for direct labor I need actual hours, actual rate, actual cost, and I need standard hours allowed for actual production, don't forget, not for budget but for actual production, standard rate and standard cost. Okay, I need firstly actual here for actual at the top of the slide, again on the right side here, sorry, the left side here, I have actual cost of direct labor and actual hours. Again, I have actual cost 84 and actual hours 40, so there is no problem for calculating actual rate. Very simple, again very simple. Yes, how to calculate actual rate? 84 over 40 will equal 2.1. This is the actual rate, so there is no problem here for actual information about direct labor. But your problem, you will find a big problem when you calculate standard. You need what? Standard hours allowed. Don't forget how to calculate. I have equation. What is the equation to calculate standard hours allowed? This is my equation. Again, this is my equation. Actual production units times standard hours per unit. Actual production units here I have 16,000. No problem. I know it from the direct material analysis. I know that my actual production is 16,000. But I need what? Standard hours per unit. Again, standard hours per unit. If you go to the standard information, you don't have here directly the standard hour per unit. You have budget. So you will use the budget information to calculate standard hours per unit. You need to calculate standard hours per unit. How to calculate standard hours per unit? Again, from your information of the budget here in this slide at the right side here, you will find what? Planned production and standard direct labor hours. Okay, planned production. My plan is to produce 18,000 units. If I produce 18,000 units, the budget hours or the standard direct labor hours of this 18,000 will be 36. So if my production is 18, my standard direct labor hours will be 36. So I can calculate standard hours per unit. Okay, how to calculate standard hours per unit? Yes, by equation. Budget direct labor hours, budget units. Again, how to calculate standard hours per unit? Budget direct labor hours here in my information 36. I need 36 to produce 18. So how many hours per unit? 36 divided by 18 will equal 2 hours per unit. Okay, so maybe I give you directly the standard hours per unit 2, or you will use the budget amounts to calculate the standard hours per unit. How to calculate standard hours per unit? Here I have my equation, budget direct labor hours divided by budget units. Okay, if I have standard hours and already I have actual production units, I can calculate here, I can calculate Yes, I can calculate standard hours allowed for actual production. 16,000, this is actual production times 2. 16,000 is given, the amount is given, but 2 hours per unit calculated, and the total is 32. Again, your problem is how to calculate. Standard hours allowed, yes, 32. Again, 32. I need a standard rate. How much is my standard rate? Not given. Again, not given here. Only I have for direct labor, if you go to the budget information, you have what? Planned production. You have standard direct labor hours, 36, and you have direct labor at the budget, $90,000. See, again, direct labor cost at the budget here, okay? And the standard direct labor hours at the budget here, 36. How to calculate standard rate? Don't forget standard rate per hour. Again, per hour, not per unit. If I have standard direct labor hours 36, my cost will be at the budget, okay, will be 90. How to calculate the rate? Very simple, by equation also. This is my equation to calculate the rate. Yes, budget direct labor cost على budget direct labor hours. Again, budget direct labor cost over budget direct labor hours. Here budgeted all of them from standard. All of them, again, blue color, okay, not red color. Red color I speak about actual in my slides. Okay, here I use my budget of direct labor, 90,000, and my standard for direct labor hours 36 will equal 2.5. Again, will equal 2.5. I calculate standard per unit, standard hours per unit. I calculate standard rate per hour. Then there is no problem in calculating standard cost. If my standard hours allowed 32 and my standard rate is 2.5, again 2.5, the standard cost will equal, again, will equal, yes, will equal 80, okay, will equal 8. If I have this information, I am ready now to prepare performance report, if my requirement is to prepare performance report or to prepare equations. According to my requirement for direct labor, I need to analyze my variance using three-way. Again, using three-way. This is my table after calculating. Again, this is my table. This is my table. Yes, the first step is calculate the total variance. The total variance is the difference between actual cost of direct labor, 84 here, and standard cost for direct labor is 80, so the difference is, yes, actual more than standard, so positive. Positive means unfavorable. Positive 4,000 unfavorable. This is the total variance. What are the reasons? According to three-way, I have 3 reasons. Maybe hours, we don't say hours, we say efficiency, don't forget. Maybe rate, maybe both of them, okay? The first one is what? It's efficiency variance. Again, efficiency variance. This is my table. To know how can you get your amounts from your table. Very simple if you remember your equations. For efficiency, actual hours minus standard hours times standard rate. Here actual hours 40 and standard hours 32 and standard rate 2.5. Again 2.5. Okay, this is my efficiency variance. 40 minus 32 will equal positive 8 times 2.5 is the standard rate. So I speak about yes, positive, 20,000 unfavorable. It's efficiency. What is the second? Yes, rate. The rate variance, yes, the rate variance is the difference between actual rate minus standard rate times standard hours. From our table here at the top of our slide, you can get actual rate here 2.1 and standard rate 2.5, and also you have standard hours allowed here 32,000. If you have these amounts, you can calculate the rate variance. This is my rate variance. Again, my rate variance. Here 2.1 minus 2.5 will equal negative 0.4, will equal negative 12,800 favorable. Negative, yes, joint variance, my joint. Again, this is my joint. Difference between hours here, positive 8,000, I mean. Between rates, negative, positive times negative will equal negative 3,200. Again, 3,200. So negative means, yes, F, favorable. Here I have 3 reasons. One of them unfavorable, efficiency, and the rest are variances favorable, rate and joint. Okay, don't forget again, I explain why I have the total variance of direct labor. So what? The total variance of direct labor here in my example is 4,000 unfavorable, must equal what? Efficiency, rate and joint. The total of sum is 4. Again, you have to check your answer. You explain why you have the total variance. So the sum of variances must equal the total. Okay? Up till now, we solved the first requirement, direct material using 4-way. We solved the second requirement, direct labor using 3-way, and the rest is 2 requirements. One of them for what? Variable overhead. Again, variable overhead. I told you, if you remember, analyzing variable overhead, because it depends on hours, like direct labor, we depend on hours, so the same equations, the same performance report, but maybe I have little bit difference in terms. Okay, this is my information. I have only one amount for actual cost of variable overhead. Here I have 124. Only one amount actual cost, but I need for my table, I need actual cost, actual rate, actual hours. Here for budget, here I have planned production, standard direct labor hours. This is my budget according to standard direct labor here in my example, and budget variable overhead. Again, budget variable overhead. In my table, I need 3 amounts actually and 3 amount standard. Okay. Actual cost, I have only what? The total of variable overhead here. This is my total, 124. Only I have this amount, but I need to know actual hours and actual rate. I don't have any information here to calculate. Okay, if I know actual hours, I can get actual rate. If I have actual rate, I can get actual hours. Okay, I told you, if I prepare my budget in my previous lectures, if you remember, if I prepare my budget using direct labor hours, again using direct labor hours, very important, you have to keep this information in your mind, okay? If my budget is prepared using direct labor hours, I will use the same actual hours and standard hours in analyzing variable overhead and fixed overhead. I mean the same actual hours and the standard hours which you calculate when you prepare direct labor table, okay? Again, don't calculate again. You need to recalculate or calculate separately actual hours and the standard hours if your budget is prepared according to machine hours, okay? Again, you have to differentiate between if your budget according to direct labor hours or machine hours. If your budget according to direct labor hours, use the same actual hours and standard hours which are calculated when you prepare the table of direct labor, when you calculate the variances of variable overhead and fixed overhead, okay? I mean overhead, manufacturing overhead. But if your budget according to machine hours, here you have to calculate actual hours and standard hours for direct labor only when you analyze direct labor hours. Analyze direct labor variance analysis, okay? And you have to recalculate again actual hours and standard hours using machine hours if your budget according to machine hours when you analyze the variances of variable overhead and fixed overhead. So here there is no problem because my budget is according to direct labor hours. So I will use the same actual hours and the same standard hours. The actual hours, if you remember, 40,000 given. So I can calculate, actual rate. And here also, I will use the same standard hours, 32. Again, no recalculation for actual hours and standard hours if my budget according to direct labor hours, okay? How to calculate standard rate for manufacturing overhead? Standard rate, I mean the blue color here, and I don't have the rate, but I have the total budget and the total hours here, the direct labor, so I can calculate the standard rate, not NEO. See, budget variable overhead, budget direct labor hours here, because my budget according to direct labor hours here 108 over 36 will equal 3. This will equal 3. Here, very simple. I will not calculate actual hours and standard hours again, but your problem is to calculate standard rate. How to calculate standard rate for the budget? The cost divided by hours. Like direct labor cost divided by direct labor hours. Here, variable overhead divided direct labor hours, okay? If I have standard hours allowed and standard rate, I can calculate standard cost, okay? My requirement here after preparing this table is to prepare performance report. Again, performance report. Do you remember performance report? I can prepare performance report for direct material, for direct labor, and here for variable overhead. I need what? This is my table. I need actual here 40 times 3.1 will equal 124. And in the number 3 here I have pure standard hour, standard rate 32 times 3 will equal 96. In the middle I need to calculate actual hours but using standard rate. Again, actual hours, here I have from number 1, 40, and standard rate 3, so will equal 120. For variable overhead, the difference between 1 and 2, spending variance. Here, 124 minus 120, so the difference positive. Positive means U. The difference between 2 and 3, yes, efficiency variance. Efficiency variance. Okay, spending and efficiency. Don't forget, the difference between 1 and 3 I mean, is the total variance. Here 124 minus 96 will equal positive 28. Don't forget, you have to check, like in 4-way and 3-way, you have to check here your answer. That's the total variance here, 25. Unfavorable must equal efficiency here, 24, and spending 4. The total, both of them unfavorable, so the total of them must equal total variance. Okay? The last requirement in my comprehensive example is fixed overhead. Again, fixed overhead. Very simple. Again, very simple. This is my information. Here I have also only one amount for what? For actual cost of fixed overhead. And I have budget fixed overhead 144. Here I have planned production 18. And standard direct labor hours here 36. Here I have between brackets 90% of normal capacity. Again, not 100%, but 90% of normal capacity. In direct material, direct labor, in variable overhead, up till now I don't speak about normal capacity. What is my problem? Your problem will be only when you analyze the fixed overhead. Okay, in fixed overhead, you need actual fixed overhead costs. Here I have actual given 140, again 140. Okay, again you need firstly actual fixed overhead. It's given here. You need budgeted. Here budgeted and the fixed. Again, fixed overhead must be the same. It's fixed. Okay? Don't say it's fixed according to 144 according to 90%. Yes, 144 according to 100%, 90%, 80%. The fixed overhead will be the same regardless the change in the level of activity. Okay? I need what? Applied fixed overhead. How to calculate applied fixed overhead? I have equation. Yes. Standard hours allowed times the standard rate for fixed. Again, standard hours allowed, no problem. Why? Because the standard hours allowed, I know. I calculate standard hours allowed when I analyze variances of direct labor and use the same standard hours allowed when I analyze variable overhead. And for the third time here, I will use the same standard hours allowed when I analyze fixed overhead. If you remember, standard hours allowed 32. Again, 32. So my problem is to calculate standard rate for fixed overhead. How to calculate standard rate? You have a problem. Very simple. You have a problem. You will say, like standard rate for variable, I have equation. Cost divided by hours. Fixed cost divided by hours. Oh, there is no problem. Okay. Budget fixed divided by budget hours. But for, again, only for fixed, I need to calculate the budget hours for normal capacity. Again, for normal capacity. Only for normal capacity, not for 90%. You will say that you don't use normal capacity when you calculate the rate of variable. Don't forget the definition in cost principles. Do you know the definition of the difference between actual and the fixed? Sorry, variable and the fixed. Variable, the average will be the same. regardless, guess the activity level. So the variable related to the activity level, but the fixed is the same regardless the activity level. But I speak about relevant range of activity, okay? If you remember cost accounting. So your problem not in variable but in fixed. How to calculate the budget hours at normal capacity, I mean 100%. Very simple. If I have 36, 90%, so how many hours if I speak about 100? 90%, 36. So how many hours? Very simple. Cross multiply. 36 times 100 over 90 will equal 40. Again, will equal 40. Okay? So when you calculate the standard rate for fixed, you have to be assured that your budget hours are at normal capacity. Okay? So if I give you, like previous example in previous lecture, if I give you my information about the normal capacity or 100%, so there is no problem in solving my problem. But you have to concentrate before solving the problem. Your capacity is 100% or less than or more than, maybe less than or more than, no problem. But if it is less than, you have to calculate, okay? Again, you have to calculate. I have actual cost. I have already budget, both of them given. And I need to calculate standard hours allowed here. This is my standard rate using the hours at normal capacity. After calculating standard rate, and already I have standard hours allowed 32, I can calculate applied fixed overhead. If I have actual, budgeted, and applied, I can prepare my performance report. This is my performance report for fixed overhead. Actual 140, budgeted 144, and calculated applied fixed overhead 115,200. Okay? The difference between 1 and 2, which variance? Yes, budget variance. Here 140 minus 144 will equal -4. It's budget variance. The difference between 2 and 3, again, yes, what is the difference? What is the name I mean? Capacity variance. Again, capacity variance. The difference between 144 minus 115,200 will equal positive. Here I have one of them negative and the second is positive. The difference between 1 and 3, don't forget, will equal what? Yes, will equal to the total variance, and the total variance must equal the sum of budget and capacity variances. Here's the difference between 1 and 3, 140 minus 115,200 will equal positive, 24,400 unfavorable. This amount must equal the total of budget and capacity variances. Okay? Now I can say I finished the first part of my course, how to control manufacturing costs through standard costing. In next lecture, bismillah, I will begin the second part in our course. Thank you. Assalamu alaikum wa rahmatullah.